Hello, it's Jonathan Wellham of ROCKLINC Investment Partners, and I'm here with Jesse Vandermeer and Andrew Chang, and we're looking forward to today's webcast called Stay the Course. We've got some interesting choppy waters all around us, but our focus will be to stay the course in terms of where we are heading going forward. So there is a PowerPoint below on your link that you now are on, so you can see that PowerPoint, and I'm just going to move over to that PowerPoint right now, so that we can get moving in terms of the presentation. So you have up in front of you now just the title, and let me just quickly go to the next slide. That is our disclaimer, an important legal announcement, and encourage you to read through that at your leisure. And let's look at the outline of the presentation here now. I'm just going to talk just very quickly about our investment philosophy, investment challenges, some of the key issues that we see in 2021 and beyond, a little bit about our strategy and positioning, and a quick update on our investment performance. Today, we're going to highlight a little bit to do with green infrastructure. It's sort of the the buzzword, and everybody's talking about green investing, and we just wanted to highlight some of the areas where we have seen some opportunities and have some investments. We're also going to talk about Thermo Fisher, which has the stock code TMO, and then question and answers. So let's just jump right into it. In terms of ROCKLINC, most of you are already aware of this, but just in terms of context, we're up to about 185 million, 180 households. We've seen some very good growth this year, which we're thankful for. And we're in the business of creating high quality, very customized portfolio, differentiating ourselves by looking at what's going on in the world and not just following what other people are doing. And that's what we emphasize on that slide. On the next slide, we again just highlight that we like to buy excellent companies. When we do talk about the businesses on the back half of this presentation today, you're going to see that we're investing in companies with, high returns on equity, strong balance sheets, good cash flow, and we like to run focused portfolios. It's important that we're not all over the place, that we focus, we understand where we're investing. They're well-researched stocks. That way we can outperform over time. We like to hold stocks for reasonable periods of time so that we can tax defer and enjoy the benefit of compounding. We also try to pay attention to the price of the stocks. And we're going to talk a little bit about that today. Stock market is expensive, and that means we have to be very careful in terms of a margin of safety. And of course, understanding the economic backdrop. And we've got some real challenges ahead of us from our perspective, and so we need to understand how that factors into our investing. The investment challenges which we've talked to you already about and which we've already incorporated into our portfolios are not changing. In fact, they're probably getting worse. So that's the excessive global debt, and we'll talk a little bit about that. Unfunded government promises. Our governments love to make promises without having the financial backing. Demographics, the aging of the population. And in fact, with the coronavirus, this whole COVID-19 and the lockdowns, it's actually led to birth rates that have plummeted in 2020, and that's going to have an ongoing impact for years to come that we should be concerned about. Monetary policies, as we've already mentioned before, are central banks here in Canada now, the United States, around the world, they're all in the money printing business. And boy, they love printing money, and that's also facilitated these record low interest rates as they've bought up all the bonds and driven interest rates down. And then this whole lockdown folly, which we've talked about in our presentations, and we'll talk a little bit about this in the presentation, but not too much. But this has just made the four challenges that I've just already mentioned above even worse. So it's created more debt, more problems with the demographics, more unfunded promises, and more money printing. And so everything's been put on steroids, basically. So in terms of 2021 and beyond, what are we concerned about? I mean, there's many things that you can be concerned about in terms of the capital markets. So high valuations on the stock market, central banks that are monetizing debt. That means they are just printing money to pay for the debts that we're incurring. The Bank of Canada is doing around 20 billion a month, 5 billion a week that they're committed to. And in the United States, it's a good 120 billion a month, plus, plus, plus. That doesn't even include all of their guarantees that they are providing for a lot of corporate debt. We've seen an unprecedented increase in debt levels due to the lockdowns and government overreach. And now I'm just going to mention on a slide or two this whole idea, you're probably reading about it, this building back better. You hear lots of politicians talking about, we're going to take advantage of this flu bug and somehow we're going to build back better. And we have this sort of reset ideology that's sinking into many countries, but certainly it's alive and well in Canada. And whenever you have the government telling you that we're going to build back better, you better beware is what you better be focused on, because the government doesn't build anything back better. And so we'll talk a little bit about that in a second. In terms of valuations, I just have a couple of slides. We do think the market is very expensive. No question about it. On any kind of traditional measure, this is a price earnings ratio looking at the big US stocks, the S&P 500. You can see that we're about 2 standard deviations. Those of you who remember your stats course, which puts us way off the average sort of price earnings ratio, which is at the 0 line right in the middle of that chart. And we haven't quite reached the internet bubble of 1999, 2000, which I lived through. But we're getting close, especially on the technology stocks. Everything, the technology stocks are trading at just crazy valuations in many cases, and you have to be very selective. And whenever we're speaking in generalities, of course, there's always the risk of that, you're going to miss individual opportunities, and that's precisely what we're focused on. But overall, there's this real frothiness that's come in to buying any kind of technology stock that benefits from lockdowns. And so we want to be careful. We've seen this game before, and it does not end well if you're not disciplined in terms of your approach to the market. This next slide, they call this the Buffett indicator after Warren Buffett. It takes the total market value of publicly traded securities and then divides that by the size of the economy. So in the United States, you take the publicly traded securities, and when that value is greater than the overall US GDP, stocks are starting to trade on a higher range. They start to say they're getting expensive. Currently, the valuation of all of the US publicly traded securities is running about 60% higher than the total GDP within the US, which puts it at the high range. So again, it's just another warning that we need to be very attentive to price. In terms of just a couple of slides which highlight the money printing that's gone on, this is a slide just focusing on the US for a moment. And if you look at the left-hand side of this chart, I'm just going to talk to that one part of this slide. You can see that, the money that was in the system was around $4 trillion. And then with COVID, that's quickly jumped, north of 7. And currently it's probably closer to $8 trillion right now, which means that the US is, practically doubled its money supply. And if you were to go back to 2008, so 2008, the money supply was about 800 billion, so less than $1 trillion. So basically in 12 years, you've had, similar to something like a 10-time factor, 10 times the growth in money printing in 12 years, which is truly astounding to say the least. The Bank of Canada was a lot more disciplined in years gone by. They'd get into some printing exercises, but really they're backing up the spending of the federal government to a large degree, along with the provinces. This chart here just shows that in 2020, the Central Bank of Canada just went into the money printing business big time. And I would argue that's largely to support the current level of spending by the federal government, which we'll get to in a few moments, as well as the provincial governments. And when you think of the Ontario government, which is virtually broke with a $400 billion accumulated debt, people, they really can't float this debt on the market and get people to buy it at current interest rates. So who's going to be the buyer of last resort? It's the central bank, which prints the money to buy it. So this is a problem here. It's a very serious problem that Canadians should be very concerned about. And we're really getting off track here when it comes to this money printing and spending. Now, the U.S. also is addicted to debt, and I just put this up just to demonstrate that, if the world's strongest economy is spending and going into debt at this rate, that should concern us. And I'm not even focusing here on Europe and Japan and China, But just think of the strongest country in the world economy and also the reserve currency of the world, being the US dollar. I mean, look at this trajectory here over the last number of years. You've gone from less than $5 trillion back in 94 to over $27 trillion currently. And you can just look at the trajectory. It's off the charts. It's completely unsustainable. And this sort of economic folly will come back to hurt us, and we need to be careful as investors. I just put this up, a lot of times people say, what are unfunded liabilities and how big are they? And so I thought, we'll do this pick on the US here, and just will give you a sense of all of these promises that governments typically make. And, the United States is not alone, but we'll again focus on them because they're the world's most important economy and they have the reserve currency of the world. You can see here that if you go down here, you can see that they have assets of $4 trillion, say. But look at the debts, the unfunded Medicaid promises. That's when you present value the promises. What are they worth today versus the promises that they made in the future? 57 trillion negative. Social Security negative 44. The publicly held debt, which we talked about already in the previous slide, 20 trillion. Then there's the pension and retirement monies, negative 8 trillion. Look, the bottom line is they actually owe, on present value basis, about $132 trillion. And that's up 9 trillion in the last year. And so, again, the point here is debt a problem in the world? It is a big problem, to say the least. Now, I put this chart in here just to show that what the result of COVID-19 or this coronavirus and the government's response to this and the expense of locking down economies, shutting down your private sector, but keeping your public sector going full steam, basically. And so when you look at this chart, let me just focus on the far left, because that's Canada. And these are reasonably up-to-date numbers. We put this chart in a previous webcast, and of course, the numbers have all grown since the previous webcast, but let me just walk you through this quickly. So if you look at the Canada on the far left, you can see GFC at the bottom. That stands for the global financial crisis. So it's how much money did our government spend and how much stimulus was there by the central banks in 2008, 2009, 2010, while we had the global financial crisis. And you can see in Canada, it was about 5% of our GDP. In fact, the government at the time, the Harper government, was committed not to going further than 3% into debt, the spending as a percentage of GDP. They were very, very careful, very, very prudent. And Mr. Flaherty, our finance minister at the time, was very careful, and we came through that very well with about 5% of GDP. Look at where we are now. This is like 9 months, and this is a flu bug, for pity's sakes, that has caused lockdowns. We've spent 45% of our GDP in terms of a combination of printing money by the central bank and the fiscal deficit that our governments have incurred. It's shocking. I mean, these numbers are absolutely shocking. Look at the US. I mean, the US also has gone crazy in terms of the spending, and you can look at the other countries. But this is a problem. This is not a sustainable situation. And we need to be aware of this in terms of investors. Then when you look at the overall debt, I just put this up from a global perspective just to give you a sense of the tradable debt in the world. This doesn't include derivatives and all sorts of other unfunded liabilities. This is the tradable debt in the world. We're now around 275 trillion US, and that's up about 25 trillion this year. It's truly staggering when you look at the trajectory here of these numbers, just to give you a sense that debt, after the global financial crisis, everyone said, okay, we got to get this debt in order. Well, we did none of that. We actually exacerbated the problem and sped up the debt creation in the global economy. This slide here just emphasizes how serious the problem is, and this just gives you a sense of what's the value of the bonds in the world that trade at negative yields. That means when you buy the bond, you're going to get less money back at the end when the bond matures. So it's telling you that if there's negative yields, it means that those economies really are in palliative care. This is not something that's sustainable or healthy at all. It might seem great for a borrower, but remember, there's a saver on the other side. If you can't get a return on your capital, then you have a sick economy. And so you can see that in November, we actually reached an all-time high of a little over $17 trillion trading at negative yields. That's primarily in Europe and also in Japan. In fact, I just heard today that the 10-year Portuguese bond has now gone negative. And so you might remember a few years ago that Portugal, Spain, Greece, Italy, Ireland, and so forth were all nations that were basket case financial situations. It's hard to believe that 12 years later that you can actually, if you buy a Portuguese bond, you're going to get less back in 10 years. I mean, it's shocking to say the least. I put this up here because, of course, the whole 2020 has been all about lockdowns and about coronavirus and COVID-19. And as you know, our position has been that you quarantine the sick and you leave the healthy out to build the economy, and that this has been really, really overstated, to say the least. And so I put this up just to give a sense of, look, we live in a world where people unfortunately die, and we want to be careful with the level of deaths and so forth, but we need to put that in perspective. So if you look at Canada on the far right, go back to 2018, you can see the yearly deaths in the different areas, like cancer at 80,000. Accidents on the road, 13,000. And currently, just to update the numbers, we're running, if you believe all the numbers and they're properly attributed, about 12,000 people in terms of COVID. Again, as we know, 80% of those numbers are in long-term care facilities, which need to be really protected and safeguarded. Healthy individuals below 60, you're talking about a handful of people that have actually died in that category. And so, we just tell our investors, we need to put pressure on the government to open up our economies, to act responsibly, to protect the vulnerable, but not to shut down the economy, which we can ill afford. And this doesn't, of course, get into all the other complications and other factors, including suicide, drug abuse. And we know the list of issues that, abuse in homes and so forth that have resulted as a result of these lockdowns. Now, a couple of just slides here, just zeroing in on Canada. This slide should concern every Canadian. It is shocking when you look at this slide. Now, what do we got up in front of us? This basically looks at a 9-month period, 9 months. And you can look at the change in our debt to GDP ratio. How much has that changed in the last 9 months? And in terms of Canada, we're right at the top of this list, and this is not one to be proud of. It really is an indication of incredibly poor leadership and inept leadership, really, in terms of our governments. So Canada, we've seen an increase in our debt to GDP of almost 80% in 9 months. That's contributed by the government. The largest portion of that would be the federal government. As we know, we're running a deficit somewhere around 400 trillion, plus or minus. If you can understand and believe the numbers coming out of Ottawa, the non-financial corporates have also gone up a lot, and the households are continuing just to imbibe in the debt. And so again, this is very, very disturbing in terms of the wrecking of the Canadian balance sheet at a rate which it's hard to believe is even possible. In terms of the Canadian household debt, it continues to grow, as you see here. And that's the blue chart. So the little blue chart, you can see that this is just looking at Canadian household debt. And what's interesting here, though, is that the service charges, the debt burden, that's in the red, the debt burden actually has come down recently. And this probably explains a lot of the housing market and people out buying homes and a certain amount of liquidity in the midst of all of the lockdowns and the pullback in the private sector. And so why would the debt service ratio go down, the debt service cost or the debt service burden? Well, interest rates have dropped. You can get a mortgage, 5-year mortgage for 1.7%, which is shocking in and of itself. But also all of the money, the government transfers, all the money that's been flowing from the federal government, and it's washed into the system. But again, the problem here is this is not sustainable. It's dangerous. And as we rack up more and more debt, that servicing burden is going to increase at some point, particularly when we run out of firepower or the printing of money can no longer be sustained without driving up huge inflation in our country. Then we mentioned just quickly this Build Back Better stuff and this reset ideology. You're probably hearing this, certainly Krista Friedland and Justin Trudeau, as they attack the Canadian balance sheet at an unprecedented level. And even when you compare that to other countries around the world, we're the leaders in this. We've seen the federal debt go from $700 billion to over $1 trillion in less than 12 months. We're adding about $1 billion a day to our national debt. If that's not shocking every Canadian, I'm not sure what would. It is an outrageous amount of money, especially when we're not getting anything from it other than money being pumped into, we're certainly not into productive assets, and it hasn't helped in terms of us cutting our unemployment rate and employment jobs. The next 3 years, though, if you listen to the last update budget from Krista Freeland, she says that the Liberal government's committed to an extra $100 billion per year, about 4% of GDP, over and above their normal level of spending. And this is going to grow the economy, make it greener, more innovative, inclusive, and competitive. Well, if you believe that, then I think we could sell you all sorts of things. And because governments don't grow an economy, and governments do not allocate money wisely for greener. That's in the private sector, and they certainly don't make things more innovative and inclusive or competitive. So they say they're going to create 1 million new jobs, and my response is, who are they kidding? These aren't the kind of jobs we need, that need to be ultimately created in the private sector, and they need to be highly productive, with the discipline of capital allocation that takes place only in the private sector. So I would argue the result is going to be ultimately an expansion of the state into all parts of our lives, which we've seen. We're going to see less freedom, which is clearly been happening, less freedom of expression, freedom of speech in this country, much lower productivity than would be the normal if it was put into the private sector and we didn't have the public sector growing at ridiculous rates. And we're definitely going to see higher taxes on income, especially for people who make a little bit more. We're going to see higher taxes on spending, because I'm not a betting person, but I would wager the HST goes up. And it's been rumored for some time, and Trudeau, as we know, would love to put the capital gains inclusion rate up. And so when they're talking about building back better, what they're talking about is building big government, taking away personal freedoms, interfering with the private sector for their dreams to spend more money into areas that have, in many cases, no current economic justification, which should ultimately be driven by the private sector. So be very, very careful. This is more about government overreach and government control, and it certainly isn't going to be building anything back better. So in terms of how are we positioned from a strategic point of view, we've talked about this in the past, so I'm just going to mention these quickly. We minimize exposure to financial institutions because of the debt, the leverage, and the eroding credit markets. We minimize exposure to consumer discretionary, and we're much more into consumer staples and reoccurring businesses that people need. We maintain healthy exposure to precious metals, gold, silver. These are very important hedges to what we see in terms of the abuse of our central banks and our government spending. We also maintain significant investments outside of Canada in order to get higher levels of growth, maintain good diversification. We invest in essential businesses with strong balance sheets, maintain good liquidity, keep some cash around so that we can take advantage of volatility in the markets. And we are trying to be very patient. We do not want to chase stocks. Valuations in some areas we've got here are insane, and they are the multiples. I've seen this before in 99, 2000. It does not end well. Just because a company is a great company, it doesn't mean you can pay anything for it and get a return. So we want to be very careful. And the last two slides just talk about our summary of our performance as of November 30th. And this is our overall book of business. So this includes about 70% equity, 30% bonds. We actually now have a 10-year number because we're in our 11th year. And you can see over the last 5 years, we've been averaging, after all fees, on a sort of a balanced portfolio, 10.6% a year, 8% over the last 10 years. So we've been very pleased with the performance, especially given the quality of the companies. And the last slide I have here would just be our performance. When you look at the equity portion of our portfolio, the 100% equity portfolio, you can see again that we've been averaging over the last 5 years about 17.2%, last 10 years 13.2%, just on the pure equity side. And you can see the comparison to the TSX, the Toronto market. That's the total return market with dividends reinvested. and then the S&P 500 total return also. So we've been very pleased to generally be above the indexes for the life of the firm, which is now getting close to 11 years. So that's where I just wanted to highlight some of those bigger picture issues in terms of the company. These are important times for us, and we need to be really, really careful going forward in terms of the business. And there's lots of challenges. That's not going to stop us. That's why we say stay the course and stay focused on the opportunities. I'm going to turn this over to Jesse Vandermeer, who will pick up and talk a little bit about some of our green investments, which I know is a really popular area in terms of the overall capital market. So Jesse, over to you.
Thank you, Jonathan. As Jonathan mentioned, I'll talk about the green infrastructure sector. Investor sentiment has been positive, to say the least, in the past 12 months. So there's some interesting developments that we've seen in the market. Nearly every client would hold a renewable energy power producer, so it's very pertinent to client portfolios. Some interesting developments in the sector: sharp trend higher in ESG reporting. We see this especially on the institutional side. Within company reports, all the stakeholders seem to have an increased focus on environmental, social, and governance reporting. We also see interesting market volatility in some names in green infrastructure, whether it's in the EV space, Nikola, Tesla, companies like those, or hydrogen fuel cell, such as Plug Power. There's been some extreme valuations in those companies. And in general, valuations for these renewable power producers have certainly increased in the past 12 months. So it's important to highlight our investments in this space. In the PowerPoint slide, on the next slide, you'll see the S&P Global Green or Clean Energy sector has outperformed the overall market, which is great for our client portfolios, but we remain conscious of the valuations, which have certainly increased. Some factors have aided the valuation push in the past year. Some might include anticipation of a new administration, COVID spending, especially related to green infrastructure, and then overall lower interest rates. Lower interest rates boost the value of assets and long-dated cash flows. We've held these businesses for over 10 years. This is not a new sector for us. We're not chasing companies at this point. These are companies that are well established across client portfolios. And we've held them for the inherent stability of these cash flows and the quality of them. Some growth drivers include governments and companies. Governments, especially years prior, have been initiating through tax credits and so forth the development of green infrastructure. Recently, we've seen countries such as the UK, South Korea, and Japan have certain carbon-related commitments out to 2050. However, in terms of going forward, we place less hope in terms of government and their commitments because they can be fickle, and we place more emphasis on the potential of corporations building out their own green infrastructure. And we see them being the sustainable driver into the future. Companies like Amazon, Walmart, and big giants like those, they specifically source their power from renewable power. Just this morning, interestingly, Amazon released a press release, and they noted that by 2025, in 5 years, all the power for all their businesses will be renewable energy. So this is really interesting. This provides a great opportunity for the companies that we own in this space. And we see that companies and corporations in the private sector, they're going to be the driving force going forward. I'm just going to switch up the PowerPoint here of these slides. And I'll quickly go over, skip. You can see the performance of the S&P Global Clean Energy sector versus the overall market. And the slide I want to get to is the cost, what they call the levelized cost of electricity. And what's fascinating to see that over the past 10 years, the decrease in the cost of renewable energy, especially solar, which is down over 4/5, it's declined precipitously, which is great as the scale, as the capacity has built out and the operating scale has increased, the costs have come down. And we see that the market is excellent at driving down costs. And in some regions, it's fascinating that solar and wind energy is more competitive than cheap natural gas. So this is the power of private enterprise and capitalism at work. And we own companies that benefit from building out all this infrastructure. The four main companies that we own, and nearly every client owns one of these in some form. Brookfield Renewable, which is the largest, TransAlta, Algonquin, and Northland Power. Brookfield and TransAlta we've owned since for over 10 years, Algonquin and Northland Power in the past several years. These are very, very high quality renewable energy companies, and they're at the forefront of building out the green infrastructure around the world. These are all Canadian based. In Canada, as we mentioned before, we actually have a nice selection and a high concentration of high quality power producers that were kind of at the forefront of building out years ago green infrastructure, and now they've gone global, which is fantastic. Approximately 85% of the world's industrial energy is still derived from fossil fuels. So this presents a great opportunity, a long runway for growth to build out more infrastructure. We can see the renewable electricity capacity additions by region, and through the years, it's been a steady increase year by year. This year, there's been some capex reduction in spending, but it's set to increase next year, and we only predict that this will continue on in this trend. Very quickly, we are keeping an eye on some alternative energy developments, which are very exciting. Some of these include battery innovation, a way to store, because renewable electricity is quite intermittent. Some improvements in battery innovation is very important. The electrification of the grid, and hydrogen. So we keep an eye out in these areas, and they have positive implications for hard to decarbonize sectors such as transportation, aviation, steel and cement production. So these are fascinating developments. We're keeping an eye out for them. We hold the very best, in our opinion, of global renewable power producers, and the valuations certainly have increased, and very careful to adding in some areas, but we still see great opportunities, especially given their global growth profile. I'll now switch it over to Andrew, and he'll talk about Thermo Fisher.
Great, thanks so much, Jesse. Last year in our December webcast, we highlighted a company called Thermo Fisher Scientific. Since then, a lot of things have changed over this period of time, hasn't it? COVID-19 has dramatically affected the economic landscape. It has disproportionately benefited some companies while unfairly punishing some others. COVID-19 has created a bifurcation of winners and losers in the economy. We thought what we would do for this webcast would be to review the company from last year, Thermo Fisher, and see how well it stood up in light of our current economic backdrop. How has our investment thesis held up in a unpredictable and difficult economic environment? I'm just going to switch to our PowerPoint presentation. And what I'm going to do is I'm going to give a recap of our Thermo Fisher. So you might have seen it, or maybe you haven't. And so this will be just a quick recap of this company. So Thermo Fisher is the world's largest maker of scientific and laboratory equipment. Now, pharmaceutical, biotechnology, academic, government, and research laboratories rely on Thermo to provide them the tools, the equipment, and solutions that they require as everyday part of their work. And the reason for that is because they have a wide offering of instruments and solutions that are used across all facets of the science and laboratory research process. Now, Thermo is a partner to many of these leading corporations in diagnostic, healthcare, industrial, applied sciences. Now, for instance, Thermo helps pharmaceutical companies across the entire spectrum of drug development, and that includes from drug discovery to drug manufacture. Thermo has an extensive portfolio of molecules, assays, reagents, cell culture media equipment, and tools used in drug discovery and drug development. They're also a manufacturing powerhouse, which means they have a massive capacity, massive capabilities for commercial manufacturing in biologics and drug pharmaceuticals. Now, one of the benefits of investing in Thermo versus your traditional pharma or biotech company is that you're not confined to a particular area of science or medicine or that next big discovery. You don't have to worry about the potential risk of a trial phase being terminated. The benefit of Thermo is that you get to share the overall growth of the science and drug development activity. So that's one of the things that we like about Thermo. We don't have to find that one or two winning drug because we have exposure to so many different areas of pharmaceuticals in the science sector that we really get that diversification benefit. Now, the investment rationale for owning Thermo Fisher, as I kind of briefly mentioned, is that they have an extensive offering of solutions that really makes it a one-stop shop for all laboratory and pharmaceutical development needs. They have consumable products which are used, which are replenished and used each time after they are used. And that accounts for about over 50% of its business. And that gives the company a nice annuity stream and gives it a predictable and stable business model. So, and even in the midst of a recession or even the midst of a pandemic, there is this stability, there is this predictability because of this recurring revenue stream that we get from consumable products. Thermo Fisher is truly a global company and has an extensive manufacturing distribution network with a broad geographic footprint. This gives the company the ability to benefit from the economies of scale in purchasing, inventory management, and product turnaround. It has end-to-end capabilities in drug development, from clinical trial logistics to commercial manufacturing. And lastly, it has a successful track record of acquiring and integrating new technologies. So it builds upon its organic strategies, and it's also astute and disciplined in its inorganic strategy for growth. It has a solid financial position and $7.5 billion in cash, giving it some great dry powder to make tuck-in acquisitions to enhance its current portfolio. Now, as I mentioned earlier, a lot has really changed over the past year. Now, how has Thermo Fisher performed over this period of time? Well, over this period of time, Thermo has been able to leverage its scale, its deep relationships, and its massive manufacturing capacity to thrive in a difficult environment. You know, at the beginning of COVID-19, in just a few short months, Thermo Fisher has created a brand new business, actually an over $1 billion business in COVID-19 testing and vaccine and therapeutic development support. Thermo has been supporting the development of customers' COVID-19 test kits by offering what is used reagents and consumable products in their PCR, that testing device. Thermo Fisher has also developed its own COVID-19 test kit, and it's actually become the gold standard because of its accuracy. Thermo Fisher also has over 250 COVID-19 related projects in progress across the globe to support pharmaceutical customers launch their therapies, their vaccines, as they enter into human clinical trials and out into the manufacturing process. Thermo Fisher is a reliable partner in accelerating the development and commercialization of COVID-19 treatments and vaccines. They're working around the clock across the entire spectrum, from providing substances that go into drugs and also the manufacture of the sterile injectables, the thing that's actually used to contain and inject into a patient. It also has the ramping up its capacity to support customers in developing new and existing therapies, not just COVID-19, but many others to meet their compressed timelines. For instance, Thermo Fisher has produced and distributed a year's worth of medicine in just a couple of months in order to meet possible demand for anti-inflammatory treatment for COVID-19 symptoms. In just a few months, they've distributed over a year's worth of medicine. You can imagine just the tremendous amount of manufacturing capacity that's required to be able to accomplish that. And the fact that Thermo Fisher has that scale and that ability, that efficiency to do that in such a short period of time just shows how efficient and how good the management team is able to deliver and perform in such a short period of time. Now, over the second and third quarter, basically the height of the COVID-19, they've generated a combined over $3 billion in COVID-19 related business. In Q2, so the second quarter of this year, Thermo generated organic revenue of 11%, and that jumped all the way to 34% in the third quarter of this year. It generated very high free cash flow growth of 50% in the second quarter and 158% in the third quarter. That's a lot. That's a huge amount of growth. It's actually reached record free cash flow in the company's history. Now, looking at the individual business segments. So life sciences has been one of the primary beneficiaries. It's generated strong demand for its COVID-19 relating testing kits, instruments, sample preparation, vaccines, and therapeutic developments. The analytical business, instrument business, has taken a bit harder on the chin. It's been negatively affected from lockdowns. However, as lockdowns gradually got lifted, workers were able to return back to academic and research labs. Specialty diagnostics business also benefited from strong demand for testing kits and PPE protective equipment. And lastly, the laboratory products and services business had strong demand for therapy and vaccine support, cold storage, which is used to house and transport these vaccines, because these vaccines need to be kept at a certain temperature, otherwise they become insterile, and plastic used in the testing workflow. So how has this all translated in terms of stock performance? Well, on the next slide, you'll see Thermo Fisher's stock performance a year later. Over this period of time, from last webcast to December 4th, I have it, Thermo Fisher's stock has appreciated over 48%. 48% since we last highlighted the company, and that's been a beneficial help to many of our clients as we have owned this stock over many different client portfolios. Now, how does that compare? So that's great, but how does that compare with other competitors? Now, we have a massive company, Pfizer. Pfizer is the one that's producing one of the leading COVID-19. Now, you'd expect that Pfizer stock would appreciate just as significant. It's such a large company, but as you can see that over that same period of time, the stock's only appreciated 10%. Merck, another large pharmaceutical company, has actually declined 8.5% over this period of time, and Roche has increased 11%. As you can see, just Thermo Fisher's diverse portfolio, its ability to build strong relationships and have very quick manufacturing capacity, all translating into strong free cash flow growth, strong earnings, is translated into this high quality stock performance that we see in the stock. So I'm now going to turn the presentation over to Jonathan for Q&A.
Thank you very much, Andrew. Just a quick question, just a couple of questions I'm going to ask each of Andrew and Jesse, and some that came into us. In terms of Thermo Fisher, I mean, amazing results, and it does indicate why we're looking at companies that have more depth and breadth and not just a single product, which Andrew emphasized. You look at Pfizer, yeah, it's all in the news, and it's wonderful that let's hope that vaccine is successful, but it does not necessarily create that much capitalized value for a company. It's not as much as you might think, given all the hype in the marketplace. And so just quickly on Thermo Fisher, just one critical area, they've generated all this extra free cash flow, the money's coming in very quickly. Where are the, say, 2 or 3 areas that they're focusing on reinvesting that, so that 5 years from now, the company should be that much larger? And so it's not just, again, got a quick growth this year, but continue to sustain a reasonable level of growth, albeit not as much as we've seen this year.
Right. Yeah. So Jonathan, there's 3 areas that Thermo Fisher deploys its capital. In inorganic means, which is mergers and acquisitions, and through the distribution back to shareholders in terms of dividends and share repurchases. Now, Thermo Fisher's primary deployment of capital is in organic means. So last year they deployed about $1 billion in research and development. And they also are finding themselves, given in light of the massive demand that they have, they're finding a good problem that they're reaching manufacturing capacity. And so what they're doing is that they're deploying their capital to expand the manufacturing distribution, because there's going to be a large amount of demand coming into 2021 for vaccines and more so these testing kits. And so they're deploying it in those areas. But at the same time, they're also looking at new different areas. So the great thing about Thermo Fisher is that they're disciplined. And so they were looking at a company called QIAGEN, which is a diagnostic molecular company. And they decided not to continue forward because QIAGEN wanted more money. They wanted more money. And so Thermo Fisher's like, you're great, but we're going to be disciplined and we're not going to pay up for that because we don't think that it's over expensive. So those are some areas that Thermo Fisher looks to. They're constantly looking at different opportunities, different areas to grow the business, either strengthen their existing portfolio or look at new areas that might be adjacent that they can venture into.
Yeah, that's a great thing about some of the larger companies that have a lot of cash flow. They can buy up, smaller companies, enterprising companies, and then incorporate that into their business and then grow it even faster so they can keep that organic growth in the underlying business. Thank you very much, Andrew. Just over to Jesse quickly, just before we end. This whole area of green investments, green technology, I know you hear it everywhere, ESG, environmental, social, governance. Look, we're not governed by that. We're looking at companies that are honest, hardworking businesses that know how to run their business, know how to make a profit, selling honest and ethical products. So we're always looking at that space, which is why we were in some of the businesses that we were in long before it became really popular in the last year or two. But Jesse, when we're looking at this space in terms of the green space, I mean, what you highlighted there, and maybe just say a couple more words about it, is that these green businesses like solar and so forth, although they can't run at night and they need storage for them, they really are becoming very economic. They're actually able to compete with other sources of energy, which is amazing. And so the cost curve, as you saw, has come way down, way much further down than I think most investors or people realize. And that's what's really important for us. We're not going to invest if it's something that needs government subsidies or doesn't, can't cut its weight. So maybe just a quick on this solar and some of the areas. So that area of solar, particularly like Brookfield Renewable, is putting a lot of money in that area. It's just staggering in terms of what they're seeing for growth. And then also just make a comment that, we've got hydrogen, we've got all these other different sources of energy, electrification, and different tech, new sources of renewable energy, and how our big guys will take advantage of those new technologies in their platforms, which is what we see as a great opportunity because they can integrate. So maybe just comment a little bit on the solar and Brookfield Renewable, and then just some of these new technologies and how they are getting, how our companies will actually benefit, the ones that we own, and potentially new companies that we might find to invest in going forward.
With solar, it's interesting because the cost curve for solar has come down dramatically, as you saw in that one chart. So it's interesting for Brookfield Renewable. They say themselves that solar will be the biggest part of their portfolio in the next 10, 20 years, where historically it's been smaller and much smaller than wind. Wind lent itself to be built out more quickly and in many areas, and because solar's cost curve was still quite high, even a few years ago, in some places it didn't make sense. But now with solar being so cheap in terms of the materials and the production, the capacity of solar is going to be huge. So for a business like Brookfield Renewable, it very well will be the biggest part of their portfolio.
Which is really saying something, because Brookfield Renewable is a very large company with one of the largest hydroelectric platforms in the world. I mean, their hydroelectric business is just massive. So to say that solar is going to compete with their hydroelectric business is amazing, to say the least.
And then about hydrogen and how that integrates in their platform. Hydrogen it's been the concept and technology has been around for a while, but the economical integration into businesses and in the industry is still kind of in its infancy, and in terms of integrating to the grid. The great thing about Brookfield being so large and having multiple technologies is that we don't have to look necessarily at buying the new players or the small players. The risk return profile lends itself more to being venture capital than something we might have in our client portfolios. But when you own Brookfield Renewable, you have Brookfield Renewable partnering with the hydrogen players, and we have exposure to that space in that way, which is something that we prefer rather than owning the smaller and newer guys directly.
Okay, very good. There's just a couple of questions I see that came on the screen. I'm just going to give some really quick answers, but then we can follow up if you need more in-depth answers. One of them is interest rates have come down so low, and a lot of people say, well, that justifies these really high PE ratio, price earnings ratios, that you're going to pay a lot more for a stock simply because interest rates are come down. No question that a decreasing interest rate environment will allow stock prices to go up, but not to the levels that we've seen in some of the securities out there. Plus, if you are a prudent investor and you want to protect your capital from a downward move, you don't want to continue chasing higher and higher price earnings ratios because when it reverses, it is really, really rough. So yes, decreasing interest rates will allow stock prices to levitate somewhat, but that point comes to an end because it doesn't become reasonable, and it's certainly not wise to be paying 40, 50 times earnings for a stock. The interest rates are depressed. They're unnaturally low. This is not sustainable. Eventually, there will have to be a reset, if you will, in terms of interest rates, because right now they're being artificially held down because of money printing, and the government's buying up these bonds and then pressing the interest rates down and bidding the price of the bonds up. So we want to be careful. Yes, it does occur, but we don't want to be caught justifying valuations that don't make sense. So it's a very good question. And then the other question that just came up here, which I see it, and I think I'm just going to deal with it. I know that the webcast has gone on for a little longer than normal here, but the person is just talking about how much money the government's pumped in. And I think to look at the long and short of it is the public sector cannot replace the money that the private sector is creating. And so remember, the public sector lives off the private sector. And so if you can shut down large portions of the private sector and hammer the economy, the government cannot print enough money. It cannot spend enough money to replace all of that efficiently and effectively. And as the questionnaire points out here, the government spent like twice this, way more than what the private sector has been hit, and yet it's incredibly inefficient, unbelievably inefficient. And that's why we must ultimately starve government to keep it as small as possible, as nimble as possible, because $2 in the hands of government is not as effective as 50 cents in the hands of the private sector that will allocate it wisely, prudently, and do it much more efficiently. So yes, the government's put so much in; it's created a lot of liquidity, but it's not going into the economy and creating jobs and being effective. And there's nothing like the private sector looking after itself and creating the wealth that only the private sector can do. The government cannot replace it. And so this is the problem. And when economists just look at spreadsheets, they go, okay, this money is equal to this money. It's not. $2 in the hands of government is not the same as $2 in the hands of the private sector at all. And we should know that. You do not want the post office running our businesses, right? You don't want the post office, if you will, being the new Apple and coming up with innovation and creativity. You just have to look at the government and most of the government units and how they're run, and you'll say, we do not want these expanding further into the private sector. You can look at, one of the reasons why we have so many problems in terms of this coronavirus and COVID is the socialization of our healthcare system is incredibly ineffective. It was running at capacity long before the coronavirus hit, and of course it can't take the extra volume. And so what we should have been doing over the last 8 or 9 months is, why weren't we increasing the size of our healthcare capacity to care for vulnerable people, rather than going into debt, $400 to $500 billion in this country. So anyway, you're going to get me off on politics, so you don't want to do that. But look, we need government, we respect government, but it must be kept to its rightful size and rightful responsibilities. And so we in the private sector need to push back, and are thankful for the currently the opposition that we see in Ottawa, and the pushing back on the government spending and trying to expose just the mass misallocation of capital that's going on in this country right now. So with that, on a cheerier note, let me just end and say that we appreciate all of our clients' support. And look, we do look forward to 2021. It's going to be full of challenges, but that's what we're here to do. And we're going to be focusing on the opportunities in the marketplace. And we certainly wish all of our clients a Merry Christmas, Happy Holidays, a wonderful New Year, and we look forward to serving you in the year to come, and are very appreciative and thankful for your patronage and the fact that you're our clients. We appreciate each one of you and look forward to building stronger relationships going forward. So thank you very much, and all the best. Bye now.